This is the video I regret making, but no one is talking about this. Here goes. Most YouTubers, including guys like Warren Buffett, have said that buying the S&P 500 index and holding it for life is a great investment strategy. Here's the problem. That strategy is like driving a car by only looking through the rearview mirror. You wouldn't drive like that. So why would you invest like that? There's a giant tsunami coming, and your favorite YouTubers haven't kept you up to date. Why? Probably because they benefit when you sign up with their broker, whether it's Webble, Moo, or whatever. Here's the tsunami they didn't tell you about. It is an estimate that baby boomers own roughly 56% of all U.S. shares in existence, as reported by the Wall Street Journal. This has always been the case. The oldest generation has worked the longest and had the most time to save and invest. That part is normal. But if they own roughly half of all the shares in existence, you should be asking yourself, what happens to the market when they begin to pass away? The passing of the boomers is the downward pressure no one is talking about. The supposed 9 to 11% returns that guys like Warren Buffett and Scott Galloway refer to won't happen. It's in their best interest to keep you believing that over a long enough time, that's what you'll get. But you can't find two generations where the investments that made your parents rich will make you rich. My great-granddad told my granddad to buy railroad stocks. He wished he had bought more, as he would have become rich. My granddad did buy them, but he made very little money. He then told my dad to work for a single company for 30 to 40 years. Since he'd need to work that long anyway, he might as well do it for one company and let them take on the risk of his retirement. The problem was my dad couldn't find a job that offered a pension. He ended up being part of the generation that bought a house for $65,000, which is now worth $2.3 million. Now, I don't want you to give up just yet, but you should understand that the likelihood of you having similar returns to previous generations is a flawed metric. Jack Schwager in Market Wizards even said that if historical data shows something is likely, he's more inclined to bet against it happening again. You need to understand that baby boomers represented a massive increase in population. After the war ended in 1945, a baby boom occurred. In 1965, those boomers entered the workforce, providing businesses with cheap and abundant labor. As this generation got older, they built skills, took on senior roles, and increased productivity. This had a massive impact on stocks. Just look at the chart from 1945 to 2020. It's basically straight up. Here's the problem. The stock market had massive growth, and the 9% average return Warren Buffett talks about happened because more people entered the workforce, creating more demand. There were more people building houses, having kids, and driving cars. So all markets were in high demand. There were 2 carpenters, 2 doctors, and 2 mortgage brokers for everyone that retired. This is not the case for us. We have fewer doctors, fewer carpenters, and fewer mortgage brokers than before. With fewer people, how can we expect more? Back to the car analogy. Everyone is looking through the rearview mirror. If they just looked through the windshield, they'd see the giant tree in the road, and they'd need to adjust course. By now, I hope you haven't given up on buy and hold, but that you're open to the idea that it won't be the same. Would you still be happy if stocks only returned 7% over time? What about 5%? Before he passed, Charlie Munger, ironically, Warren Buffett's business partner, suggested that stocks would underperform for years to come. One main reason I trade is because I don't want my financial success tied to the hope of continued economic growth. If anything, you should look into a satellite approach to protect yourself. The real tsunami. What happens when boomers start passing away? So what happens exactly to the stock market when boomers start passing away? Here's where things get tricky. Boomers own a huge chunk of the stock market, 56% to be exact. As they begin to pass away, large portions of these assets will need to be sold. Why? Because their estates will have to settle taxes, probate costs, and divide assets among heirs. And not every beneficiary gets to hold on to stocks. They might need to sell to pay off debts, buy a house, or simply diversify. With this massive wave of selling, the demand for stocks could struggle to keep up. Younger generations, like millennials, don't have the same wealth or investment preferences. They might not reinvest in the same way the boomers did. With fewer workers entering the economy and millennials carrying larger student debt loads, productivity and growth may not match the past, adding even more downward pressure on the market. If millennials are fortunate enough to inherit, many will likely use part of that money to pay off debts that once seemed insurmountable. In other words, the demographic shift will change the stock market's landscape. The historical returns that made boomers rich may not repeat for future generations. If half the shares in the market come under pressure from estate liquidations, it's unrealistic to expect the same level of returns from the S&P 500 that we've seen over the last 75 years. That's why you can't just look in the rearview mirror. You have to consider the road ahead. For now, I'm not telling you to give up on index investing, but understand that there's inevitable downward pressure coming. This won't make past returns equal to what's ahead. Don't take this as negativity. Some of the comments will probably frame it that way. Instead, use this as a way to prepare. Whether, like me, you look for ways to profit in other markets regardless of direction, or you choose to invest more with the assumption that a lower rate of return is required to achieve your goals, you must understand this. Life isn't fair. It's not equal across generations. Some will have it better than others, but regardless of the hand you're dealt, it's on you to play your cards well. Until next time, signing off.